How should you invest your money? This is one of the first questions new investors will ask. With so many options, many get confused or stuck on where to start. In this video, I am going to show you how anyone can easily build a globally diversified portfolio. This portfolio uses a strategy that, according to a Nobel Prize-winning economist, is mathematically certain to outperform most investors. All it takes is 3 investments. You heard me right. That's 3 investments. It's so simple, it's almost unbelievable. My name is Nick Doyle. Welcome to my channel where we talk about personal finance and investing. Today, the topic is asset allocation. Building any portfolio should start with an asset allocation plan. Asset allocation is how you divide your money across different asset classes. It is one of the most important tools for meeting your investment goals. Some people might be investing to retire early, others may be saving for a house, some might be saving for their children's education, and yet others might be about to retire and need a constant stream of cash. Whatever your goal is, you need to understand asset allocation. Let's review the major asset classes. U.S. stocks, international stocks, U.S. bonds, international bonds, cash, and alternatives. There are many types of alternatives. Some are real estate investment trusts, hedge funds, commodities, and so on. Asset allocation can get complex, but most people don't need to go beyond the basics. I'm going to explain these basics and share what is the simplest and best investment strategy for many people. If you enjoy videos like this, don't forget to smash the like button and subscribe so future content lands in your inbox. When you invest, you want diversification. While buying individual company stocks could make you rich quickly, one bankruptcy could be devastating. The best way to diversify is to buy index funds. These index funds own a small slice of every stock or bond in their respective market. Instead of buying individual companies or bonds, you just buy the whole market. It's very easy and costs next to nothing to do so. In fact, this is how Warren Buffett recommends most people invest. He even went as far as to bet some of the world's top hedge fund managers that they couldn't outperform the index. The hedge fund managers lost the bet. These are people that went to Ivy League schools and invest money professionally. The same way you don't want to own just one company, you don't want to own just one asset class. If you have all your money in U.S. stocks, and the U.S. has a long period of no growth like Japan did for the past 30 or 40 years, that would be devastating for your portfolio. The asset classes have different levels of risk, letting you construct a portfolio that meets your needs. Another reason you want to own different asset classes is that they get different returns each year. While U.S. stocks might go up one year and bonds might go down, the following year, stocks might go down and bonds go up. In aggregate, they tend to balance each other out and minimize the swings in your portfolio. By using multiple asset classes in your portfolio, you can minimize the risk and potentially increase your returns. In which asset classes should you invest? Enter the 3-fund portfolio. This portfolio consists of the total U.S. stock index, the total international stock index, and the total U.S. bond index. This portfolio may sound too simple or not well diversified. However, between the 2 stock indexes, you would own over 10,000 individual companies across over 40 countries. The U.S. bond index holds thousands of bonds from hundreds of issuers. It includes mortgage bonds, government bonds, and corporate bonds across all maturities. You couldn't do better yourself if you tried. This is really all most people need. The next logical question is, how many of each should you buy? First, let's start by acknowledging that I am not an investment professional. I am sharing what I have learned from reading numerous books on asset allocation and how I invest my own money. You should always consult a professional if you aren't comfortable being accountable for your own decisions. Deciding how much to allocate to each asset class is a personal decision. It needs to account for your individual risk tolerance and your investment goals. The stocks in your portfolio will have the highest risk and the bonds will have the lowest risk. By changing your allocation to these different types of asset classes, you can adjust the risk and long-term return of your portfolio. If you are investing for a short period of time, like saving for a down payment on a house, or if you are risk averse and can't tolerate the potential 50% drop you could see in the stock market in 1 year, you should have a higher allocation to bonds. If you can tolerate a 50% drop in 1 year, or investing for the long term and want the best return, you should have a higher allocation to stocks. To illustrate this, I will give two examples. My portfolio consists of 55% US stocks, 25% international stocks, and 20% US bonds. While my grandpa's portfolio, who's over 95 years old, consists of 17% US stocks, 8% international stocks, and 75% US bonds. These portfolios reflect our different goals. I'm looking to invest for decades and get great long-term growth, while he's just looking to pay the bills for the remainder of his life. Now I'm going to use a tool called Portfolio Visualizer to backtest these two portfolios and show you how they compare. You can see portfolio 1 is my portfolio with very high percentage in stocks. And then portfolio 2 is my grandfather's portfolio, very high percentage in bonds. So we can run this through Portfolio Visualizer, which is going to show us the results from 1987 to present. And over this time period, my portfolio would have returned 8.45% compound annual growth rate with a standard deviation of 12%. That means it was pretty volatile. The best year was 28% gain, and the worst year was a negative 30% loss. On the other hand, my grandfather's portfolio would have returned 6.94% compound annual growth rate with a standard deviation of 4.79. His best year would have been 20%, and the worst year, negative 6%. If you look at the returns of the portfolio annually, you can see that the vast majority of years, both portfolios do very well. However, there are some years where my portfolio would have dropped a lot, especially in 2008 and part of this year in 2020. I saw my portfolio drop by over 30%. Let's take a look at a real-life example of this. This year, I had a couple months where I sustained over a six-figure loss in my portfolio. Think about how that would feel to you to get up in the morning, look at your portfolio, and notice that it had dropped by over six figures. This needs to be one of the biggest factors when considering your asset allocation. The last thing you want to do is panic and sell your stocks, locking in what is a permanent loss. Luckily, since that point, my portfolio has recovered and is actually positive for the year. However, if you were an investor that couldn't stomach the drop, you would have locked in that loss and not gotten back to positive for the year like I did. Once you determine your target allocation, every year you need to do something called rebalancing. This is where you look at your portfolio and you see how it compares to your target asset allocation. Some of the asset classes will have done better than others in the year, so your portfolio will not be at the desired allocation. This means you need to sell some of the winners and buy some of the losers to get your asset allocation back in balance. This may seem counterintuitive. However, you want to buy low and sell high, and this is effectively what you're doing when you rebalance. You don't want to try and time the market because most investors are horrible at this, and they end up doing the opposite, where they buy high and sell low. You need to pick a date and rebalance yearly to your target allocation. Alternatively, if you're contributing a good amount of money to your portfolio, you could use your contributions to bring your portfolio back into balance. Another factor to consider is how you adjust your allocation as you age. Most investors will start with more risk when they're young and gradually reduce the risk as they age and approach retirement. This allows for capturing the long-term gains of riskier assets when a big drop won't really affect you. This is when you are in the accumulation and building phase of life, where you are seeking growth and appreciation. However, once you are in the phase where you need cash, you decrease the risk to avoid cashing out just after a big drop. At this phase, you are seeking capital preservation. This concept is called a glide path. And some have a rule of thumb that says investors should have their age in bonds, meaning if you're 30 years old, you should have 30% in bonds. If you're 70 years old, you should have 70% in bonds. This is just a rule of thumb. I don't follow that exactly, but the idea is you should reduce the risk as you age. And this is called the glide path. In fact, you can actually buy one index fund that is the equivalent of the 3 or 4 fund portfolio. These are called target date retirement funds. They are the default investment option in most people's 401k accounts. Here is how the Vanguard target date retirement funds work. As you can see here, we can see the allocation split between US stocks, international stocks, US bonds, international bonds, and what are called short-term TIPS, which are Treasury inflation-protected securities. These are useful at a later stage of life where you might want extra protection against inflation when you need the cash. Vanguard starts out young investors with a very high allocation to US and international stocks, roughly 90%, and then the remainder in US bonds and very little in international bonds. Then you can see once you leave the young phase into the transition phase, they start decreasing every year the amount that you have in stocks and increasing the bonds. And at a certain point, they start phasing in some tips because then you're approaching retirement, might need that cash. And once you're in retirement, it's at a steady state with a low percentage in stocks, roughly 30%, and the remainder in bonds. This reflects the life cycle of most investors, where you would want to take higher risk when you're young and lower risk when you're in retirement and spending down your portfolio. If you value simplicity and just want to invest in one fund and be done with it, this fund is a great option and could be for you. It costs a little bit more than buying the 3 funds or 4 funds separately, but it is very simple as they do the rebalancing for you. All you have to do is keep sending money into this one fund and you're done with it. The Vanguard funds cost roughly $15 per year for every $10,000 you have invested. This isn't a fee you pay right out of pocket, it just comes out of the returns from the portfolio. So once you put the money in, it'll basically pay for itself out of the return at a rate of $15 per $10,000 you have invested. And as we talked about, this one fund holds over 10,000 stocks in over 40 countries and thousands of bonds around the world. This is all you need. There are a couple minor differences between this fund and the 3-fund portfolio. The biggest is international bonds. I don't include international bonds in my portfolio because they would be such a small percentage of my portfolio. The bonds in my portfolio serve to reduce the risk and provide a pretty steady return. And the difference between an international bond from, say, the German government versus the US government isn't going to be that drastic. However, I may change my mind at some point and go to the 4-fund portfolio just to diversify a little more. The other minor difference was the TIPS, which is the US government Treasury inflation protected security, where the return is tied to the inflation rate. This way, if we were to experience a period of really high inflation, you might be protected a little bit from that. However, this is more of a concern if you're in retirement. You may also notice this fund doesn't explicitly hold alternatives. However, the US stock market does include real estate investment trusts, so you get a little bit of exposure to some of the alternatives. I don't believe most people need these types of exotic investments. The basic 3-fund or 4-fund portfolio is sufficient for the average person. The alternative to the target retirement date funds are to construct a portfolio yourself. Now, why would you do this? It's a little more complicated. Now you have to buy 4 funds instead of 1, and then you have to do the rebalancing every year. Well, one of the first reasons is it costs a little less every year. For instance, my portfolio costs me $4 every year on every $10,000 I have invested. Well, that's compared to the $15 of the target retirement fund. If you have a pretty large portfolio, this difference could add up. The other advantage, and actually probably the main advantage, of buying the funds individually is for tax efficiency. Bonds and stocks are taxed differently. Depending on your situation, it may be advantageous to hold stocks in one type of account and bonds in another type of account. For instance, if you're investing some money in a regular taxable brokerage account and you have the target retirement fund in there, you might pay a bit more in taxes every year than if you put bonds in your 401k and stocks in your taxable brokerage account. I'll make another video on tax efficient asset allocation, but I just wanted to touch briefly on that because it's a big reason why you might want to buy the funds separately. If you don't have investments in a regular taxable brokerage account and be investing pretty much entirely in retirement plans, then this doesn't really affect you. There are investors that believe in an even more advanced asset allocation plan, which is based on some academic research that suggests by tilting your portfolio to invest a little more heavily in certain types of companies or markets, that you can increase your return a little bit more while lowering the risk. This is based on Nobel Prize-winning research from economists Eugene Fama and Kenneth French. There's since been additional research outlining other ways to improve asset allocation. I don't follow these approaches for 2 reasons. First, it adds extra complexity and fees for what I expect to be little extra return in my portfolio. I believe in this concept called reversion to the mean. What this means is that when investors spot an opportunity to gain an extra return in the market, more investors will go to get that extra return. This will ultimately result in that extra return diminishing to the point where it might even disappear. In fact, I will show you a quote from Eugene Fama, one of the authors of the original Nobel Prize-winning research. Whether you decide to tilt toward value depends on whether you are willing to bear the associated risk. The market portfolio is always efficient. For most people, the market portfolio is the most sensible decision. Additionally, he is one of 5 Nobel Prize-winning economists that share a similar view. Here are some quotes from the others. A lot of investment advisors will start with the 3 or the 4 fund portfolio and refer to it as a core portfolio. And then they will layer on some of these other strategies from this research. I don't really believe most people need an investment advisor for asset allocation if you can appropriately judge your risk and your investment goals. Once you understand that, you can go out and construct your own 3 or 4 fund portfolio, or just buy the target retirement index fund, and you're done with it. If an advisor is adding value in another way, that's great. Like they might be helping you with tax planning, estate planning, or some other scenario that you need some help with. However, for asset allocation, I don't think people need an advisor. It's very easy. There are great products out there that are so cheap and well diversified. The difference in price between, say, $5 on every $10,000 per year and the 1% a typical advisor might charge, which is $100 on every $10,000 per year, that $95 difference reinvested over 40 years is a massive amount of money. And to top it off, the advisors often get kickbacks from putting you in high expense funds. So on top of their $100, you might be paying another $100 just for the high expense fund, when you can get some of the best funds for less than $5 for every $10,000 invested. And these are funds that Nobel Prize-winning economists have said are mathematically certain to outperform most investors. Such a simple asset allocation or portfolio might not sound very exciting when you start talking about investments with your friends. They'll likely have much more exciting stories about how they bought Tesla and it skyrocketed, and they might not be telling you about how they bought some company that recently went bankrupt or dropped 50% in value. Their portfolio might sound really exciting. However, the index portfolio is mathematically certain to outperform most investors. So over the course of 10, 20, 30 years, you will most likely outperform these people's exciting portfolios with your dead simple portfolio. A good portfolio is generally boring. There you have it. You can be a very successful investor just by investing in the 3-fund portfolio or a target retirement index fund. Thanks for watching, everyone. I hope you learned something about asset allocation. Don't forget to comment below on your asset allocation and your investment strategy. And again, if you enjoy videos like this, please help me out by smashing the like button and subscribe so that future content lands in your inbox. Later.